Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site Times Square, we have Sara Rathner. She's a credit cards expert with our friends over at NerdWallet, and we're going to take a look at what interest rate decisions mean for your wallet, not necessarily just the stock market. Sara, it's great to have you with us. And there's the interest rate rhetoric is such a big conversation in what we're covering in financial media. But what does it mean? How does it impact the consumer when we see interest rates move up or down?
Well, small interest rate changes won't necessarily affect day-to-day purchasing decisions because you won't necessarily see a huge interest rate change on your credit card. But it could affect your overall debt repayment strategy because we found at NerdWallet that the average U.S. household with credit card debt has about $7,000 in revolving debt. And that means they're spending $1,000 a year on paying interest for that credit card. And so if that small interest change could save them money, then a lot of them might choose to pay their debt down more aggressively with those savings.
Well, interest rate policy also impacts how strong or weak the U.S. dollar is. How does that affect consumers?
Well, Federal Reserve data does show us that consumer spending does reflect how confident they are in the economy. But we also find that spending is cyclical. And so it really comes down more to an individual person's personal economy rather than the economy at large. And consumers are spending more in the summer when they're on vacation. They're spending more during the holiday season when they're buying gifts. So there could be some purchasing decisions that are independent of what's going on.
Let's talk about credit card management and debt management. That's another hot topic in financial media where people just have a lot of debt, student loan debt in particular.
Yes.
What's some best practices when it comes to managing your credit card portfolio?
Well, it is always really important to avoid credit card debt as much as you can. Obviously, that's not possible for everybody at every point in their life, but it is among the highest consumer debt in terms of interest rate that there is. And so it becomes much more difficult to pay that debt down, especially when you have other debt obligations like student loans, your mortgage, your car. And so, we talk about different debt repayment strategies where you might pay down the highest interest rate first and then move your way down from there. And those are all ways that you can organize all of your different debts in one place and hopefully come up with a way to pay it down that makes sense to you and actually helps you feel empowered.
Are Americans doing better at managing their debt?
It depends. Unfortunately, it depends. Debt levels are increasing, and part of that is because the average credit card interest rate is higher now than it was several years ago. And so, despite a consumer's best efforts, emergencies happen, unexpected costs happen, and student loan debt is really high. And so people are stretched really thin, and it becomes way too easy to get trapped in an endless cycle of debt.
That's interesting that you said that interest rates are higher on credit cards now. These are historically low rates than they were years ago. How come the rate's higher if we're having lower interest rates?
It's a combination of which credit cards are offered. Mm-hmm. We found the average rate of APR for credit cards is around 17%. And it really just depends on the type of card you get, which is what APR you're granted. A lot of the premium travel cards actually have higher interest rates. And also credit cards that are geared toward consumers who are newer to building credit also have higher interest rates because they're a little bit riskier to lend money to.
Yeah, well, and that certainly lends to why you want to pay it off at the end of every cycle and not fall into that trap, particularly if you do need those emergency funds.
Right, and you bring up a really good point with emergency funds. That can be a wonderful way to avoid getting into debt in the first place because unexpected car repairs, medical bills, home repairs, these things happen all the time. So if you have a sum of money set aside separately from your checking account that you can tap into when you're faced with a cost like this, you're less likely to have to put that charge on your credit card and go into debt to pay it back.
What do they recommend these days? 6 months of living expenses for unforeseeable, major events like job loss or something like that?
Yeah, a good rule of thumb is 3 to 6 months, but that's not necessarily right for everybody. When you're first starting out, you might be younger, newer in your career, maybe 1 month is all you can do. And then you might have a family that the main source of income is a freelancer, so they have cyclical income, so it might be more prudent to have even up to a year saved up, especially if it's a family that only has one working spouse. And so if that one working spouse loses their job, it can put the family into hardship. And so it really depends on your personal situation, but the most important thing is to start saving.
I agree.
Yeah.
Thank you so much. Great advice on all counts. Thanks for joining us at MarketSite.
Thank you.
And thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.